In the rapidly evolving landscape of the financial markets since the COVID-19 crisis, sharp bull markets as well as persistent corrections have been part of our lives. Terms like inflation, interest rates, as well as macroeconomic global scenarios have become a part of our daily conversations. The market, as we have been following, saw a very sharp bull market happen since March, and there has been a correction that has started in the early part of this month. The broader market saw a sharp correction, and that correction has persisted over the last week as well. So the big question that everybody has is that will this volatility that has creeped up continue? And if the volatility continues, where do you invest? So we will go deeper into the macroeconomic scenario, analysis of sectors and the economy, and try to find out these answers for you.
Let's look at the global economic health. Rising valuations rather than earnings growth seems to be a theme for developed economies, along with certain challenges for emerging markets like China. Rising interest rates, a strong dollar, inflation, geopolitical worries are just some of the global events that are at play. Have a look at this graph. In this, we can see the equity sell-off of 2022 has mostly been reversed in 2023, but it's not necessarily the case for all asset classes like we can see for long-term bonds. Factors such as persistent inflation pressures, an increase in government debt, and volatility in the macro and geopolitical arenas are expected to drive bond yields further up, which questions the relative attractiveness of broad equity allocations. While the S&P 500 has risen by over 16% this year, that growth has primarily been driven by a few firms. In comparison, the equal weighted S&P 500 has grown by only about 4%. There is also a notable stagnation in US earnings for corporate sector, along with the fact that the Chinese property market has been crashing and has a very negative impact on the broader market as well.
Another concerns that investors talk about is the valuation. When the prices are rising, it's all well and good and we take advantage of that. But after a certain increase in prices, the valuations reach a peak and they tend to correct themselves. And that is what we are seeing in the market right now. But, are we in an overvalued zone? Have we reached any sort of limit that is, a big worry? Let's evaluate that. So first, let's look at the P ratio of the Nifty. The P ratio of the Nifty, when you compare it with the historical P over the last 15 to 17 years span, you would see that it is still within 1% standard deviation of that limit, which means that we haven't reached the overvalued zone yet. To confirm, let's also look at the bond yields, right? So the difference between the 10-year as well as the 1-year bond yields is at 1.6%, which is below the threshold level of 2% when you can, very surely say that it has reached the overvalued zone. So we have not reached that 2% zone yet. So we have not become extremely overvalued in terms of the bond yield. The reason to worry would come up, in fact, when the earnings are not able to catch up to the price levels that we are seeing and the demand that we are expecting in the festive season, or because the monsoon does not pick up, and that could be a reason of worry.
One of the reasons for this volatility that we're seeing, not just in the Indian markets but also globally, is the inflation worries and the consequent interest rate rises that we've been seeing along with it. Many economies, along with US, parts of Europe, India, are witnessing rising inflations. And what is happening is that we're seeing supply chain disruptions, we're seeing agricultural crop prices increasing, there's an increased demand post lockdowns. Banks are coming out, central banks are coming out with expansive monetary policies, which have all contributed to this inflationary pressure. Central banks worldwide are closely monitoring the situation and have been actively increasing the interest rate to sort of curb the inflation prices. Inflation has already risen to an all-time high for most of these major economies, and there is avid speculation about a potential interest rate hikes in the future as well, or at least maintaining the status quo in the coming few months up to the next maybe 6 months to a year as well.
As you must be aware that the recent run-up that has happened in the equities has happened because of the buying in that, the markets have seen from the foreign portfolio investors. The foreign portfolio investors have bought in a lot into Indian equities in the past few months. But with the hawkish stance by the Fed, which has kept US rates high, which has, strengthened the US dollars, there has been a worry about FII money not coming up into the emerging markets. But still, in the long-term perspective, emerging market like India, which has a good growth rate, is extremely interesting for investors. the currency fluctuations that we have been seeing do cause a little bit of a worry though.
Another factor contributing to the volatility in the global markets is crude oil prices. The current surge in crude oil prices is largely driven mainly by controlled supply from OPEC nations rather than a dwindling supply. The current scenario is very similar to the 2005 and 2006 period, where there was a production cut by OPEC nations, which ultimately led to skyrocketing prices for oil sector, which also led to a massive amount of volatility for all economies in the world. There are three things that we need to be concerned about here: the US, China, and Saudi Arabia. From a US perspective, what we need to be concerned is in the longer term, we need US to step up its oil production so that the average demand, which is around about 1 to 1.5 million barrels per day to maintain a standard growth here, that production and that demand can be met. The second point is China. China has a huge oil inventory which could potentially influence crude oil prices if they're sold on the global markets, but it's also not very transparent about its oil inventories, so it's a very unpredictable element, and that's something that we need to be very careful about. The third point here is Saudi Arabia. Saudi Arabia is one of the nations that has recently announced its production cuts. They did this on account of maintaining volatility for the sector. However, they're also aware of the fragile state of the global economy, and they review their oil production cuts on a monthly basis, and they are looking and could potentially help the broader market by improving the production as opposed to reducing the production. Natural declines in oil fields must be offset by new production. However, attracting enough investment, given the ESG concerns that are in the space right now, has become very challenging for upstream oil projects. The hope for energy security for India and for the global economy also lies with renewable and other alternative energy sources. From a longer term perspective, it's essential for investors to understand the underlying trends and where the market is headed, irrespective of these sort of short-term volatility. So let's look at that very quickly. Historically speaking, markets have this very remarkable ability to sort of recover from downturns. We saw the 2008 financial crisis, the dot-com bubble of the early 2000s. At every point in time, the market has rebounded and has recovered and has reached new heights. So that is something that we could probably look at in the coming few months and years as well. Also beware of the upcoming elections in 2024. Emerging markets have been a strong point of growth. Countries like India, China, Brazil, a lot of African nations as well are seeing significant economic expansion in the coming years and in the coming decades as well. And as their middle classes grow and as the urbanization happens, as development happens, these markets present a vast opportunity for investors. Third point, technological advancements. From AI to machine learning to renewable energy solutions to biotechnical solutions, there is a strong promise across these new innovations and new solutions and new areas of growth, which can help propel the market and lead to a lot of advancement, not just for the market, but also for humankind. There are also various other factors that we need to be concerned about, just the demographic shift that's happening in developed economies, the changing age of the populations across the board for many of these countries, a focus on sustainability, massive infrastructure development that is happening across the world, and a lot of this will contribute to further economic growth and give ample investment opportunities.
Now let's do a quick overview of the sectors, right? So firstly, the investment linked sectors, right, where the government expenditure is happening, the defense, railway, and power have seen a very sharp rally in the last 1 year because of the capex investment that has come in. But due to the enormous price run that has happened, there has been a concern of overvaluation, and these stocks have been correcting for a couple of weeks. If these stocks do not justify those valuation numbers, then there could be a scope of correction in these stocks. In terms of future growth, the flow of money to these companies remains strong, and that could justify the valuations that they are driving. But with the election coming up and with the commodity prices being in a crisis in the global world, there could be some worries for these stocks there as well. Consumption is a strong theme for India, right? We have a huge demographic dividend, but like we discussed, consumption demand has not been that high in India for the past few months, and that has been a reason for worry. Obviously, there is big expectation on the festive season to pick up consumption demand, but right now those numbers, because of this high inflation numbers, because of the weak monsoon, do not look extremely attractive. Now let's talk about automobiles. Automobiles have been a favorite of the market for the past year or so, right? And that has been because of the sharp profitability that these stocks have seen. But yes, commodity prices are now rising, and that could impact these profitable numbers, which could cause an adverse impact on these stocks. If the festive demand picks up and there is a big growth in their demand, then that could be a positive cue. IT sector is a backbone of Indian markets, right? But even despite the sharp correction that IT has seen, the global demand for Indian IT hasn't evolved that much, and that is what we would see in the earnings that would come in. Uh, IT sector with the growth in innovation, the growth of AI has a lot of exciting things going on for itself. And if you were to bet on IT right now, look for stocks that can be a hedge for inflation, a hedge for global recession, and that would be a reason for choosing IT. Last 2 years, financial sector as well as the banking sector has given a big push to the Indian markets, right? They contributed more than 30 to 35% to the index performance. And with the stable macroeconomic scenario, with a push towards financial inclusion, this value could continue. Private lenders, private banks have already seen a robust performance, and PSU seems to be picking up right now. Talking about PSUs, PSU sector in India has seen a sharp rally over the past year, right? Defense, railway, power that we talked about are getting big, investing from the government, and these stocks will continue to scale up in the next few years as the spending in these sectors from the government is unlikely to go down. So defense and railways should be on your radar for the long term. Similarly, infrastructure as well as capital goods, because of this big capex cycle that has picked up, could also be quite attractive. Pharma and healthcare sector, another hedge for global recession, has continued to do well in the past few months, and the dynamics of these sector remain strong and could be a good bet in the current markets. Specialty chemicals, which have corrected deeply in the past year, are getting traction back. Big push coming from the bromine as well as the fomine chains could, give a much awaited pickup to these stocks.
Given all of this volatility, it's very important to try and understand where to invest when the market is volatile. While turbulent times can be very nerve-wracking, there are also enough significant opportunities for investors that are savvy enough to pick up on them. The first thing that you sort of need to be concerned about is your portfolio diversified enough? Keeping your investment spread across various asset classes, across geographies, is very critical in this sort of a market. Second is defensive stocks. Identify what are the needs that people will need regardless of whether there's a downturn or if there's an economic boom, which is typically electricity, medical care, food, and find stocks of these companies. Third, find dividend stocks. These are good for steady income and give you that sort of passive income that everyone's been talking about. Fourth, emerging markets. If you are an international investor or even if you're a domestic investor, developed markets are facing stagnation. However, countries with a growing middle class and rapid industrialization can present significant investment opportunities. Fifth, we're already seeing sectors like AI, biotechnology, renewable energy, e-commerce driving a lot of future trends and are already resulting in significant productivity boosts across the space. Investing in these sort of innovative companies can be very lucrative, but it also poses risk given that it's a very new space and there can be a lot of challenges that these companies are trying to go through. Sixth point, bonds and fixed income. These are typically good for your broader portfolio. They act as a stabilizing force, providing regular interest income and ensuring that the principal is also returned back to you at maturity. So, seventh point, historically, gold is a safety asset, and that could be something that you can consider adding into your portfolio since its price typically moves inverse to the stock market prices. There are also other precious metals like silver that you can consider adding to your portfolio as well. Finally, you should keep a portion of your portfolio in cash or maybe other very highly liquid assets, which allow you to capitalize on these investment opportunities as they arise. Because if you have cash, you have liquidity, you have that safety net, and you can go and invest when the market is not doing well. And if you're able to identify those correct pieces to pick up in the market. Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Don't forget to like this video and subscribe to the Wright YouTube channel. We will be back with many more insights, reviews, and market updates in the coming weeks. Till then, click on the bell icon to stay tuned for more such amazing Wright updates. Happy investing.